to our comprehensive guide on stock market vocabulary. Whether you're a complete beginner or someone looking to brush up on the basics, understanding these essential terms is the first step to navigating the world of investing with confidence. In this video, we'll break down the most important stock market concepts, explain their meanings, and show you how they fit into real-world trading. By the end, you'll be equipped with the knowledge to make smarter investment decisions and communicate fluently in the language of finance. Let's dive right in and start building your financial vocabulary together. Start with the basics. A stock, also known as a share, is a financial instrument that represents ownership in a company. When you own a stock, you actually own a small fraction of that company, which entitles you to a portion of its assets and profits. Companies issue stocks to raise money for their operations or to fund expansion. Each unit of stock is called a share, and owning shares means you're a part owner of the business. This foundational concept is at the heart of the stock market and investing. Stock market is the official marketplace where investors buy and sell shares of companies. It's a dynamic environment where prices change constantly based on supply and demand. The market connects buyers and sellers, making it possible for companies to raise capital and for investors to trade ownership in businesses. Whether you're buying your first share or tracking market trends, knowing how the stock market operates is crucial for every investor. Bid price is the amount buyers are willing to pay for a stock. Think of it as the highest price someone is ready to offer at any given moment. If you want to sell your shares, you'll typically receive the current bid price. Understanding the bid price helps you know what you can expect to get when selling a stock, and it's a key part of every transaction in the market. On the other side, the ask price is what sellers are asking for their shares. It's the lowest price a seller is willing to accept. If you want to buy a stock, you'll pay the current ask price. The difference between the bid and ask prices is called the spread, and it's an important factor in trading costs. Knowing the ask price helps you understand what it takes to enter a position in the market. Bull market describes a period when stock prices are rising, and investors are generally optimistic about the future. This positive sentiment often leads to increased buying activity, driving prices even higher. Bull markets can last for months or even years, and they're typically associated with strong economic growth and investor confidence. In contrast, a bear market is when stock prices are falling and investors feel pessimistic about the market's direction. This negative outlook can lead to more selling, which pushes prices down even further. Bear markets can be challenging for investors, but understanding them is key to managing risk and making informed decisions. Neutral market, sometimes called a sideways market, occurs when neither bulls nor bears dominate. Prices remain relatively stable with little significant movement in either direction. This can be a period of uncertainty where investors are waiting for clearer signals before making big moves. Understanding market conditions helps you adjust your strategies accordingly. Volatility measures how much stock prices fluctuate over a certain period. High volatility means prices can change rapidly and unpredictably, while low volatility indicates more stable prices. Major events like earnings reports, interest rate changes, or election results can cause spikes in volatility. Investors often exercise caution during volatile periods to manage risk effectively. Dividend is a cash payment made by a company to its shareholders, usually from its profits. It's a way for companies to reward investors for their trust and support. Dividends can provide a steady income stream, especially for long-term investors, and are an important factor to consider when evaluating stocks. Earnings refer to a company's net profit after all expenses are deducted. This figure is crucial because it shows how much money the company actually makes. Investors closely watch earnings reports to gauge a company's financial health and future prospects. Strong earnings often lead to higher stock prices, while disappointing results can cause declines. Market capitalization, or market cap, is the total value of a company's shares. It's calculated by multiplying the current share price by the total number of shares outstanding. Market cap helps investors compare companies of different sizes and is often used to classify stocks as large cap, mid cap, or small cap. P/E ratio, or price-to-earnings ratio, compares a company's current share price to its earnings per share. This metric helps investors determine if a stock is overvalued or undervalued relative to its earnings. A high P/E ratio may indicate high expectations for growth, while a low P/E could signal undervaluation or concerns about future performance. A stock index is a group of selected stocks that represent the performance of a particular market or sector. Examples include the Sensex and Nifty. Indexes are used to track market trends, compare investment returns, and serve as benchmarks for funds and portfolios. ETF, or exchange-traded fund, is a type of investment fund traded on stock exchanges. It holds a basket of assets such as stocks or bonds and allows investors to diversify their portfolios easily. ETFs combine the flexibility of stocks with the diversification of mutual funds, making them popular among both beginners and experienced investors. Liquidity refers to how easily a stock can be bought or sold without affecting its price. High liquidity means there are plenty of buyers and sellers, so trades happen quickly and at stable prices. Low liquidity can make it harder to enter or exit positions and may lead to larger price swings. It's a key factor to consider when choosing stocks. Face value, also known as par value, is the original worth of a share as set by the company when it is first issued. Unlike the market price, face value does not change with market fluctuations. It's mainly used for accounting and legal purposes and is important when calculating dividends or stock splits. An IPO, or initial public offering, is when a company sells its shares to the public for the first time. This process allows companies to raise capital from a wide range of investors and marks their debut on the stock exchange. IPOs can be exciting opportunities, but they also come with risks and uncertainties. OHLC stands for open, high, low, and close prices of a stock on a given day. These four data points provide a snapshot of how a stock traded throughout the day, helping investors analyze price movements and trends. OHLC charts are widely used in technical analysis to make informed trading decisions. Volume refers to the total number of shares traded for a particular stock during a specific period, usually a day. It includes both buy and sell orders. High volume often indicates strong interest and can signal potential price movements, while low volume may suggest less activity or uncertainty. A long position means buying a stock with the expectation that its price will rise. Investors take long positions when they have a bullish outlook on a company or the market. Holding a long position is the most common investment strategy, as it aligns with the goal of buying low and selling high. Short position involves selling a stock first, with the intention of buying it back later at a lower price. This strategy is used when investors expect the stock's price to decline. Short selling can be risky, but it allows traders to profit from falling markets. It's important to understand the mechanics and risks before attempting short positions. Square off refers to closing an existing position in the market. If you've bought shares, squaring off means selling them. If you've sold shares short, it means buying them back. This term is commonly used in day trading and helps investors lock in profits or limit losses before the trading session ends. Stop loss is an order set to automatically sell a stock if its price falls to a certain level. This tool helps investors limit their losses and manage risk, especially in volatile markets. Setting a stop loss is a common practice among traders to protect their investments from unexpected downturns. 52-week high and low represent the highest and lowest prices at which a stock has traded over the past year. These levels provide context for current prices and can help investors identify trends or potential support and resistance points. Monitoring these figures is useful for making informed trading decisions. Mastering stock market vocabulary is essential for anyone looking to invest or trade. These terms form the foundation of financial literacy and empower you to analyze markets, understand news, and communicate effectively with other investors. The more you know, the better equipped you'll be to make sound decisions and avoid costly mistakes. Now that you've learned the key terms, it's time to apply them. Start by reading financial news, analyzing stock charts, and practicing with virtual trading platforms. The more you use these concepts, the more comfortable you'll become in the world of investing. Remember, learning is a continuous journey, and every step brings you closer to your financial goals. Even experienced investors can make mistakes if they misunderstand key terms or concepts. Avoid confusing similar-sounding terms and always double-check your understanding before making trades. Taking the time to learn the basics can save you from costly errors and help you build a solid foundation for future success. The stock market is always evolving, with new terms and trends emerging regularly. Stay updated by following financial news, reading books, and joining investment communities. Continuous learning will keep you ahead of the curve and help you adapt to changing market conditions. Congratulations on taking the first step toward mastering stock market vocabulary. With these essential terms in your toolkit, you're ready to explore the world of investing with greater confidence. Remember, knowledge is your most valuable asset. Keep learning, stay curious, and use your understanding to make informed decisions on your investment journey.